Good morning, everyone. Welcome to this update for global stocks and commodities for the 2nd of April. Apologies for the absence of a video last weekend, but I was somewhat indisposed in hospital. But nevertheless, back to the task at hand now. So it's pretty obvious that what's going on in America now is more than just a rally that's due to Donald Trump. There's much bigger factors at play. The fact that the rally started before the election in some sectors, and also the fact that there's now some doubt over whether Trump will be able to get his policies through, yet the market has held up remarkably well. And that's because there are bigger issues that are driving this market, and all the rest is just short-term noise, including prognostications about whether Trump is going to be able to do what he says he will do. So the important thing here is to stay focused on the big picture. Let's have a quick look through. Now I did get quite a lot of emails and commentary from the video 2 weeks ago, where I provided some big picture perspective. And I know a lot of people appreciated that perspective. So I'm just going to run a couple of slides again from that video 2 weeks ago, because it is valuable information. It's incredibly important to retain a sharp perspective, and I just want to remind people who watch this video of what the real important issues are. But just before I get to that, this is just a bit of a big picture update. So we're certainly looking at a multi-year level in making these, in fact, probably a multi-decade level. In terms of history, this is the third longest economic expansion we've had in the US, and that economic expansion started in 2009, 10, 11, somewhere around there. You could argue exactly when it started, but it certainly is a very long expansion in economic history. But it's also one that's been very, very slow, very, very modest. So because it's been going on now for what seems like an eternity, human nature kicks in and says, well, look, it just can't last any longer. This economic expansion has got to roll over soon. But I mean, if you look at Australia's case, we're now in our 25th official year of economic expansion, and I'm sure people were saying after 7 or 8 years in Australia that it couldn't continue. So, history shows that those sort of things don't die of old age. They don't have a time limit on them, and they can continue for a lengthy period of time if circumstances permit. So the question that I would throw at those that are just waiting for the economies to roll over, waiting for the stock market to roll over, is stop doing it, because there's no reason why this can't continue. And as I said, look, there's been a very loud chorus in America for at least the last 2 years saying that, the end is nigh and we've got this massive top, and there's been lots of high-profile commentators trying to make a name for themselves. And all they've done is they've just frightened a lot of people out of the market. This has been the least robust expansion that I can find. And so the consequence of that is that we haven't created the normal excess, that exuberant excess that needs to be washed out. So without a boom, there's not the necessity to have a bust. And for those viewing this who are in Australia, I mean, obviously we're seeing at the moment the West Australian economy is very much a boom-bust economy, and that's the cycles that it goes through because it is so heavily reliant on the resource industry. But a lot of other areas of Australia have not really gone through an excessive boom, and so there's no reason for them to go through that bust. And technically, there really are no signs of a top, none whatsoever. And periodically, I go through that exercise where I look at the S&P 500 index, and we just look at the moving averages, and we look at the changing character of the market, and there just isn't any. So until we do, then you stay with what is. There is normally a blow-off phase at the end of any major stock market expansion where people start to get convinced that the rally will go on forever. And at that stage, the last money, the educated money, floods into the stock market. It has this massive blow-off phase, and then it's all over because the fundamentals have just got, or the prices have just got way ahead of the fundamentals. and also there's very few buyers left to sustain the market, and so down it comes. But we haven't had that blow-off phase. The level of investor confidence has remained very low, and there's still plenty of money that can go into the stock market. So we haven't had the blow-off phase yet. That normally happens, so that's why I'm not perturbed about a top. Now, this was one of the two slides that I want to highlight that I put up last week. They're just really important big picture perspectives. Don't try and get the first 10% of a new bull market or the last 10% of a bull market. Focus on the 80% in the middle. That's the critical bit. Clear your mind of all the other garbage that gets put in there by the media or that you may generate yourself because of your own biases. Be decisive, keep it simple, particularly keep it simple is just so important. I talk to so many people that want to develop complex plans and think this whole process is quite convoluted and tricky. It's not, it's just really simple. The hard part is what's going around in your head. So the task of individual investors and traders is to protect the capital that they've got and to generate a profit. So the ways that you do that, you don't try and second guess bottoms in the market because that's a way to get carved up. You wait for confirmation of a turn higher. That means that you are probably going to miss the first 10%. But once you've got confirmation, then be decisive and buy in that sort of area. It's impossible to know where the bottom is. And human nature is that we hold off until we feel comfortable. Well, if you wait until you feel comfortable, then more than half the bull market is finished. So you're going to miss out on a lot. So even though you're not getting the bottom, invariably the thought process around that period and the economic news is probably not going to be all that great. So it does require confidence and a bit of a leap of faith. But when you've got technical confirmation of higher highs and higher lows, then that's when you should be starting to put money to work in the market. Stop buying once the market character changes. So stay with the trend until you start to see the things that I've pointed out in those big picture analyses of the index. Be open-minded enough to respond when there is confirmation of a top. So confirmation of a top typically is we start to get wilder swings, much more volatile conditions, and we get sharp plunges and sharp rebounds and then generally some sort of lower top form. When you see that happen, just recognize what's going on and significantly cut back your exposure. And then when you get confirmation of a top because you've broken one of the major lows, then you may want to think about getting out completely or according to whatever your plan is. So let's look at American stocks now. The S&P had a reasonable week. It was fairly quiet trading, really. The daily ranges were fairly modest, but it did end up 16 points higher on the week. And the question is this the B leg of an ABC correction, which often happens, and particularly when the market has been overbought for so long? I don't know the answer to that yet. I think it's a flick of a coin. What I can say is that the overbought condition, which had been the case for many months, has now been relieved. So the market is kind of back to a neutral stance, but it hasn't really sold off to oversold. So therefore, in the short term, it can still go either way. And that's why I am very neutral on whether we've got a bit more downside yet. I can say that we've got an absence of red alarm flags. There's nothing that's really causing me any concern at all. Importantly, the market breadth is holding up, so that means we're not getting, when you reach a top in a market, you get a lot of stocks starting to be sold off. They are starting to form lower highs and lower lows, and it's only really the big cap, a small handful of the bigger cap stocks that are holding the index up. That's not the case at the moment. Market breadth is holding up very nicely, which means that a very broad variety of stocks are being supported. The Nasdaq set a new all-time high, and there's no divergence between price and market breadth at this stage, which is something that I look for. However, if this is a phase 4 consolidation on a medium-term view, so we're talking 3 to 6 months, then we could have 4 to 8 weeks of choppy action. That sort of makes sense. So we don't go from overbought and then a sharp sell-off to oversold and then a rebound. That what we get is one of these kind of consolidation periods where the market really just goes sideways, and we've seen that plenty of times over the last 5 or 6 years, where the market just refuses to fall very far, and that really just allows time to relieve that bit of overbought nature. So I think that's probably quite likely that we're in a bit of a choppy phase, and we'll look at that chart in just a minute. Technology remains the leading sector, there's no question about that. That's where you certainly should have exposure. So let's jump in and have a look at the S&P. So you can see that really we finished at the same level that we were at the 14th of March. So really the market over the last 2.5 weeks has really gone nowhere. Went down and then it's rebounded to that same point. You can see that it certainly got down into that zone. So I've had this zone of likely support marked now for over a month. It got to the bottom of that zone, didn't quite make it to the 50% retracement. Got very close, as you can see, but didn't quite make it. We've come off overbought. We're down to a neutral position down here on the RSI, so it could go either way. Is a little bit lower, 23.16 possible, or even 22.97, or possibly even down here at the first level of a bigger picture correction, which comes in at 22.80. Yeah, they're all possible, but they don't change the big picture. You can see the red 200-day moving average line is still moving up very robustly. The price is still significantly above the 200-day moving average. The last time we touched it was just before the US election. So that's an indication of strength when the price is holding on to the 50-day moving average. So I think there's every chance that we might just get some sort of running consolidation that could last for, as I said, 4 to 8 weeks. And that means that really you should be focused on buying the dips. A bit more so, because we're not going to have perhaps the upside for a little while. So if you're not going to get the upside, then it makes sense that you should try and buy with a more discerning eye. Don't buy unless you can get something that's oversold. That just seems to make sense to me. So turning now to, let's look at the NASDAQ. So we're obviously at all-time highs here, and set new all-time highs in the finish of the week. So still quite robust. Let's look at the Russell 2000 for small caps. Not quite at new all-time highs, but gee, not far off it. So certainly the small caps still being quite well supported, and you can see it's really formed. It's relieved its overbought nature, not by going through some sort of significant correction, but merely just by going from mildly overbought to mildly oversold and just bouncing around there. Let's just look at the Australian index. Oh no, look at the US dollar index is important. So you can see we're just continuing to fluctuate a cent or so either side of the 100 mark. So it's a key level, and I think the market hasn't really showed its hand at this stage. So really not much to be determined from that. Let's look at the Australian dollar. Just pan back, let's get a big picture perspective. So the Australian dollar has come all the way down from well in excess of parity, which occurred in 2011. We fell into a significant downtrend that got us down to a low of 68. And since then, we've been fluctuating really in a band between 71 and around 78. We're towards the upper part of that band, but again, there's really no indication of what comes next. The 200-day moving average line is flat, The price is just flicking either side of it, so we're really just in a sideways consolidation. Clearly, if you wanted to add more money overseas to America, then adding it with the Australian dollar up around these levels has a little bit of advantage attached to it. So let's just look at the ASX 200. We managed to break 5,800. Finally, that had been a cap for some time, so we took quite an effort to get above 5,600. Then we were locked in a range to 5,800 for some time. Managed to close above that, and I think just technically the market will have a crack at trying to get up to the 6,000 level, I'm sure, just because it's there. So we may now see yet another range in the Australian market between 5,800 and 6,000. So just to confirm that, the Australian dollar dipped a little, 76.3, and the correlation with the US dollar is just seems to be temporarily broken at the moment. The ASX 200 managed to put on 112, but look, most stocks in Australia are not trending. That's really the bottom line. So I think if you're just taking your cues from the Australian ASX 200 index, then you're not really getting an accurate picture of what's going on in the Australian market. Turning now to precious metals, gold rose $2 to $12.50, so it was another reasonably solid week for gold, and particularly so that the US dollar went up. So there is sufficient buying in gold to hold on to that price. The holdings in GLD, which is the world's premier ETF, holds about 40% of the money in gold tracking ETFs. That remains steady around 832 tons, so no real sign of commitment either way there. Stocks are flatlining it now for the time being. But despite what you might think, a lot of people think gold stocks have been disappointing this year. They've actually outperformed the S&P 500 and most sectors of the S&P 500 by a decent margin. So from the lows, gold stock performance has actually been pretty good. Now, history shows that the future speculators are dead wrong about the negative impact of interest rate rises. So we've seen when the Fed, we saw it at the end of 2015, we saw it at the end of 2016. When the Fed raised interest rates, gold sold off. And the conventional thinking is that with rising interest rates, that gold, which doesn't pay a dividend yield, is therefore instantly unattractive and must be sold. And that's what we're seeing. However, history shows that that is absolutely completely wrong, because over the last 50 years, and I read a very detailed study just a couple of days ago about this. So over the last 5 decades, every time there's been a rate hike cycle progressing slowly, so sometimes the rate rises come sharply, and sometimes there is bigger gaps between when the Fed raises interest rates, and I think that almost certainly will be the case this time. And also where gold was not expensive to start with. Now, sometimes the rate hike cycle has started when gold has been pushed up quite a bit and is quite elevated. So in some circumstances, the price of gold does fall at the start of an interest rate cycle. However, where those two conditions apply, which is, I believe, where we're at now, and that is we're going to get a relatively slow and steady rate hike cycle, and where gold is not expensive to start with, then 100% of the time, gold rose by at least 30% minimum. That's what history shows. So I would much rather hang my hat on that statistic than on this stupidity of the short-term futures players. They do have an impact in the short term. There's no question about that, and that will continue. However, trying to play the very short term in gold or gold stocks is actually a pretty tough game. If you're going to be in that sector, you need to go into it with a medium term view. buy the periodic sell-offs and just be a little bit resilient if you don't quite get the bottom, and just hang on, because you've certainly got history very, very strongly on your side. So let's just take a look at gold and silver. We'll start with silver, which is outperforming gold at the moment. So you can see the 200-day moving average has been heading down in the short term, but really over the last year or so has actually moved up. So in early April 2016, silver was trading just under $15. Now it's just over $18. So there is an upward drift amongst that volatility. And you can see that silver finished quite strongly, and there's every chance that it could push a little higher yet. If you look at gold, it's a very similar pattern, but the gain since April last year has not been quite the same in percentage terms. It's only gone up around about $100 odd dollars. Let's look at it on a weekly. There's a bigger picture view on the weekly, and you can see that it's really just more of a consolidation. We did go up and basically form some double and triple tops up here. The market sold off a little bit further than I would have liked. I would have liked to have seen it go no lower than 1176. It did sell off in December to a little bit below that, but look, really that was the perfect storm of things coming together. It was the Fed moving on interest rates. It was the election of Donald Trump, with the markets going quite positive, and therefore that was a bit of a negative for gold. So I'm prepared to just ignore that very, very sharp plunge, which really only lasted from the 2nd of December to the 13th of January. So it only lasted about 6 weeks. So really we've moved up, and we're really just in a sideways consolidation at this stage. Let's look at GDX. So GDX showing a similar but slightly better kind of pattern, because it didn't dip as deeply as gold did. And as you can see let's go from the start of the year. So there's the start of the year, there at around $20.70, and we're now at $22.80. So around about a 10% gain, which outperforms quite a bit of the S&P in that same time period. Now moving on to copper and oil. Copper slipped a few cents down to $2.63 a pound. But again, there's a little bit of negative chatter around copper at the moment, but the sector is up 5.7% for the quarter. It's just been a little bit weak in the short term, so you've got to allow for that in markets. Crude oil bounced back up 4% to over $50 again, and certainly energy stocks had a good week, but I can't say if they've bottomed or not. I would, as I've been saying now for quite some months, I think it's reasonable to have some exposure to energy, keep it more on the minus side. But I think there are certainly some signs there that by the end of 2017, we could be seeing some quite good gains in energy stocks. There's the spot copper charts really just moving sideways. And this is just a reprint of the final slide that I showed you 2 weeks ago. And I think these are just really, really important reminders that don't get sucked in by the common thinking, the media thinking that uses some various ratios, CAPE ratios, or whatever, that demonstrate how overvalued the US market is. What is important is that money doesn't care about ratios. It's not important. That's just some historical figures that analysts play around with. Money goes to where it's treated best, pure and simple. People are obviously going to put their money where they think they can get the best return. And the current earnings yield in the American market is around 5%. And in fact, it looks sustainable into the future because the earnings growth is coming through. and we are almost certainly seeing a strong upcycle in earnings for the energy sector. And when you've got the 10-year bond at 2.5% and looking like you could sustain a significant capital loss over the next, say, 5 years, then the 10-year bond is hardly attractive at all. So an earnings yield at 5% with sustainable forward earnings, to me, every day of the week is far more attractive than the bond market. And that's why the stock market is doing what it's doing. So it doesn't matter what the CAPE ratio is or what the average PE ratio is. It's irrelevant. Market's just going to go where it's treated best. The process for investors to stay focused on and not be distracted by the media. Start buying once there's confirmation of a turn higher and not before. Once you've got that and we've now got a new trend, or we've got an existing trend, then buy the dips in the sectors where the fundamental drivers look most assured. I talk about this every single week, so you should know what those sectors are. Stop buying when the character of the market changes, when we start to see significant pickup in volatility. So start to reduce your exposure at that stage, a bit of a preemptive strike, and then perhaps fully exit the longs on confirmation of a breakdown. And that's really all you need to do. And put all the rest of the in the garbage in a box and stick it under the bed, because it's all it's going to do is serve to defocus you. So that's all for this week. We'll see how things unfold. We're moving steadily towards the French election, which could cause some disruption. That'll be pretty interesting. There's my contact details for non-members if anyone wishes to contact me. And let's see what the new week brings. Cheers.